This could well be the best kept secret in trading. And if you keep watching till the end, I'm going to show you how to add this to your trading arsenal. Hi and welcome back to the How to Trade YouTube channel. My name is Connor Woods, one of the trading coaches. Today, you're going to learn all about fair value gaps, which are an integral part of my trading and the smart money concepts world. What is truly great about them is they can be used in a variety of different ways as a confluence for a trade or as a standalone strategy. You can pick whatever style suits you. But first, let's learn what it's all about. Enjoy. Now then, fair value gaps, or FVGs for short, are an extremely simple but powerful concept to grasp. Now some call it imbalance, inefficiency, liquidity voids. You can call it anything you like really, but what does it actually do and what's it all about? Well, an imbalance of orders is when a market exchange receives more kind of one order, i.e. buy or sell, over the other, and not enough then of the opposite side of the order, so maybe more buyers than sellers or more sellers than buyers. Now you've got to think, for sellers to complete their trades there must be buyers on the other end, and for buyers to complete their trades there must be sellers on the other end. That's how the markets work. But sometimes we get this equation slanted heavily in one direction. That creates an imbalance in the market, which is also known as a fair value gap, and often this gap is then filled as price becomes balanced again. Now, extreme cases of order imbalances may cause suspension of trading until that imbalance is resolved, but typically the ones that we trade are the less severe versions, shall we say. Let's show you exactly what I mean theoretically now. Now, with this in mind, typically this is what it will look like on your charts. So here's just a theoretical example of the price moving in a bullish trend. As you can see, the price moving higher. Now, during that move, we sometimes see quite an impulsive move to the upside within that move. So we see quite a sharp move. Now, within that sharp move, that's when we start to see those imbalances occur between the buyers and the sellers, and that's where we get our fair value gap created. Exactly the same for the bearish example. So you see the prices moving lower. During that bearish move, we had a really sharp impulsive move lower. We got that imbalance between buyers and sellers once more, and a little fair value gap was created. I'm going to show you exactly how you measure that on the chart later on in the video, but let's take a look at some examples of when they could occur. There are some classic times when we see fair value gaps, and I'm going to list them out for you now. Probably the most common time when we see fair value gaps, when we have major economic news events. This can be non-farm payrolls day, or inflation, or central banks, or any high impact news event that can cause an imbalance. We also have institutional position, a bit harder to predetermine, but when we think about the hierarchy of market participants, those at the top of the food chain, they have the most influence on the market, and when they buy and sell, that can cause fair value gaps. If you're an individual stocks trader, mergers and acquisitions, that can be big news that can cause fair value gaps in individual stocks. Earnings releases as well, for example on indices like the Nasdaq, when you get the big tech earnings, that can cause fair value gaps. And finally, any geopolitical tensions or any war, like for example when Russia invaded Ukraine and there was a huge fair value gap created in oil prices. Let me show you how you can spot them on the chart now. Okay, so let's have a look now how we can actually spot this on a live market. So I've got the pound versus the US dollar. You can use this with any market, but I'm using this on the pound versus the US dollar. I'm on the daily time frame, but again, you can use any of your preferred time frames. The daily is just my preferred time frame, and we'll work from the current price action and work backwards. So you've seen what fair value gaps look like. So remember, we're looking for an imbalance of buyers and sellers. So we can see at the moment we're in sort of bearish territory where we're moving lower. So if we zoom in on that price action, we're looking for any moment in time where we can only see red. There's no green on either side. So you can see here, there's a gap. And we always draw it from the wick to the left-hand side to the wick to the right-hand side. So if I zoom in on that, you can see how I've drawn it from this wick here down to this wick. And in this gap on the daily time frame, we have daily fair value gap or imbalance. And you can see that's created between there only being sellers present between these two wicks. You can actually see that if we scroll down, there's a little bit of a fair value gap or imbalance in here as well. And then we can work that all the way back. Can't see anything in here. And now we're looking at a bullish example because you can see the price is moving higher. So we're looking for a situation where there was only really green candle. And you can see we've got that in here. And if you then zoom out on the chart, you've then got your fair value gaps marked. Now really, if you don't want to do this yourself, I would recommend, to practice doing it yourself manually. But if you don't want to do it yourself, there's a fantastic indicator you can use. If you go to indicators on TradingView and type in fair value, it's this one here by Lux Algo, fair value gap. And what it does is it actually draws the fair value gaps on for you. The green ones are bullish fair value gaps and the red ones are bearish. And you can see the ones that I've drawn are literally where they are anyway, basically. So you can see that we don't actually need to do it manually. We can use this indicator to do it for us, which is fantastic. But I would recommend that you practice maybe going on a few charts and trying to spot them yourself, and then basically quizzing yourself with the Lux Algo indicator and see if you got them right. Now there are many more, but it's more important that we can spot them no matter the reason why. It's also crucial to understand that fair value gaps tend to get filled. So think of them as like a magnet for prices, whether it's pulling the price higher into an FVG or pulling the price lower into an FVG. Let's look at some examples on the chart now. Now there are many ways in which you can use fair value gaps. One of the most popular ways to use them is basically as support and resistance areas. So we wait for the market to trade into the fair value gap, either in bearish or bullish, and we use it as either support or resistance. So let's look at this example here. So we know there's a fair value gap that's created in this example. And when we see the market trading down and finally, because remember, they don't get filled straight away always, sometimes it takes a bit of time, but you can see that the indicator or your drawings will just leave them on there and use them for future support and resistance. So let's say we had this one marked for a while, and now finally we get the price moving down into our bullish fair value gap, which situates here, and we're looking for it to act as a support area. Now what some people will do is, once we trade into that fair value gap, is wait for maybe a lower time frame break of structure. So we want to see a reaction and then we look to trade it higher. Or what people may do is literally try and buy it from the fair value gap. The issue with doing that is sometimes you have to put your stop loss just at the bottom of the fair value gap, and if there's one below, you might want to cover that as well. So it's a bit ambiguous in terms of where your stop loss is, but you can see how it's a good confluence for support and resistance. Because when we start to play this through, you can see how that acts as support and we get that reaction. Now in terms of, let me just rewind that back a little bit. In terms of the other way in which we can use them for profit targets. So we can use them as support and resistance, but we can also use them as profit targets, because remember, FVGs are a magnet for prices. So we're always looking for FVGs to be filled in some way. So no matter what way you enter the market, you could be entering along here for whatever reason. It might be a chart pattern, it might be moving averages or anything like that. We then use the fair value gaps as our take profit targets. So we'll have one take profit target here, we'll have another one here, and our final one up here. So we set multiple take profit targets depending on the trade we're on. So if we're buying, we set take profits at multiple different bearish fair value gaps. But if we were selling the market, let's say we sold the market up here, we'd have our take profit at the various bullish fair value gaps. Now if you actually look what happens here, the market trades, it filled the first one, that's why it got removed. And it pretty much filled the second one, which it did then, and then it filled the third one as well. So all of those bearish fair value gaps were then filled and price then become balanced. Then we get our new set of fair value gaps, and we can look to benefit from that as either support or resistance. So the bullish fair value gaps we can use as support, and the bearish ones we can use as resistance. Not that there are many actually on this market, but we can use them as resistance. Alternatively, we can use them as take profit targets. So if we do get into a trade for whatever reason, we turn this indicator on and we look for the bullish fair value gaps to be filled, and they become our profit targets. For example, if we sold here, we'd look to target these areas. And they are the two main ways in which we can use them, either as support and resistance or as take profit targets. So there we have it. Everything you need to know about fair value gaps is right there. Which way do you prefer? As an added confluence to your trading method, or as a standalone trading technique? Either way, FVGs are one of the most fun ways to study smart money price action. I would suggest now going away and practicing spotting FVGs on a chart of your choice. Soon, it will be like second nature to you. Thank you for watching, and if you'd like to, feel free to subscribe to our YouTube channel and turn the notifications on so you do not miss out on the exciting new videos we are currently recording to show just to you. Trade well and see you soon.